Your initial reaction, sir?
I'm as surprised as you are. I mean, we expected 25 basis points. It's up 50 basis points. But I think the action by the New Zealand Central Bank reflects the dilemma that central banks around the world are facing. Many of them are between a rock and a hard place. And they're fighting two battles: the slower growth, the banking crisis, and of course, on the flip side, inflation. In the case of New Zealand, it's still running very high at 7.2%, and the New Zealand Central Bank has decided to fight inflation and not worry about the fallout for the economy just yet. And New Zealand certainly doesn't have a problem with the banking sector as the US and perhaps Europe has. So that gives them a bit more space to hike. And probably the central bank felt that, it's best to front load it now. And they've set a target of, I believe 5.5%. And we're not far from that. So they could do one more rate hike, maybe 25 basis points. They could step down at the next meeting, but, they're not far. I mean, close to the 5.5% target. So there isn't a lot more room for them to keep doing 50 basis points. Not when the housing market in New Zealand is taking a massive beating. I mean, the latest numbers show a more than 10% decline in house prices, the largest annual decline in house prices. So the high interest rates are starting to impact the economy and the housing sector. It's hurting household wealth. So there's a limit to how much more they can do. I mean, they've already done 75, 50, 50 in the last few months in consecutive sequence. And I don't see them being able to do another 50 come May.
Okay. Okay. Sorry, that was my cue. Vas, is it too early to make that assumption? Because we didn't think they were able to move by 50 today.
Well, perhaps to some extent, but I feel that, the central banks around the world, including the Kiwi Central Bank, have increased interest rates dramatically. And many of them realize now that there are effects from that sharp increase in interest rates. In the case of the US, we've seen the banking crisis as a result of the very sharp increase in interest rates. And clearly, there's no free lunch. I mean, you can't keep pushing up rates like that without it having some sort of impact on households, the corporate sector, and the economy. So they've done quite a lot already. They need to give time for those rate hikes to impact inflation, interest rates. There's always a lag in terms of monetary policy and the actual impact it has on the economy. And they recognize that. So I guess they're front loading it now, and hope that inflation comes off. But if it doesn't come off, then, we're back to 50 again.
And Vasu, I'm just wondering what this means for sovereign bond yields around the world. I mean, what is the pain trade now when it comes to yields? Because on one day we could be shocked by an oil and an OPEC cut, and then you have softer data from the U.S. that can move Treasury yields in double digits. Is this sort of the new regime now in bond markets?
Well, I think so. I think, the bond markets, central banks are all dealing with this new regime where inflation continues to be a headache. As you highlighted earlier, oil prices clearly pose a problem. And and bond markets are dealing with this uncertainty as well as to what the central banks are going to do going down the road. And inflation remains a big headwind. It's cooling off, but not enough around the world. And central banks have already done a lot. How much more can they do? Because they've done a lot and inflation is not showing a big fall back to the 2 to 3% targets that most of them have. And that's a big headwind for the bond markets as well.
So how do you ride out the turbulence here? Is it still to cut duration risk?
Well, to some extent, yes, that's one way to look at it. But on the flip side, all these rate hikes that are going to take place, or which have taken place already, and the slowdown in growth may eventually translate to a recession. Now, if we see a recession in the second half of this year, perhaps first half of 2024, in the case of some economies, then duration would still be the way to go, because typically, longer duration assets tend to do well when rates are cut down the road. I mean, so if we have rate cuts down the road, still makes sense for investors to be invested in long duration. But for now, of course, in the short term, with the way central banks are moving and the way inflation is moving, it makes more sense to perhaps keep duration shorter. But if you take a medium-term view, duration is still a play.